Mcguire, CEO of XM Australia, is with us to give us a view of what he thinks is happening in global markets. Peter, thanks for joining us. One of the strange phenomena I'm noticing is that there's almost no risk or fear in this market because if the market was concerned, we would have seen an appreciation in gold prices and silver prices. And we actually see gold and silver prices go nowhere. Is it possible, Peter, that the market's really taken a view that let's just keep risk on the side and let's just play the upside in the market?
Well, good morning, Ashu. Look, I really do think you've probably hit it on the head as far as I would have thought that gold, and I was over there with you in the studio a couple of weeks back, and I expected gold to be through that $1,400 level by now. Really, I think it's been a little bit of a wake-up call for everyone. We're looking at seeing what happens as far as Bank of Japan today. The Brexit issue is certainly behind us and what the natural flow-on from Europe is, and, of course, where the US leads. It seems to be a little bit of a splutter, but I think a lot of the smart money has certainly driven crude lower, and a lot of the hedge funds certainly have piled into that short trade, and that's been very evident where the market's down around about 16 or 17% in the last matter of weeks.
Peter, what's your call about most of the Asian markets? Because the markets seems to have gotten used to or is completely discounting bad news, and we've seen that. We've had more stabbings in this 1 year and more one-man terrorist attacks than we may have seen in 10 years. A coup and all kinds of other stuff, and the market just basically says, well, I mean, that's just part of our daily lives, and we just go on. With that kind of risk appetite, could you expect maybe another 10, 15, 20% easy on the market on the upside? And actually, it may be faster because most of the stocks already gone into strong hands.
Well, when you look at it, I mean, if you look at a yearly historical, the markets, most of them globally, except the Dow and a few of the others, have been in the doldrums. And we've seen Asia more or less hemorrhage earlier on the year, January, February, March. Everyone was concerned as far as what's happening with China. Then we led up to the Brexit and we saw a little bit of a rally. Then the markets have come off and now they're ratcheting back up. And we've, of course, got more issues at hand as far as Trump versus Clinton. Seems to be neck and neck, depending upon which analyst you talk to. And I think that there's more concern as far as stimulus from Japan, what's happening there. We're expecting some, the numbers coming out of the US and what's going on with Eurozone. So all of that will flow in. And then the big brother as far as China and what's the actual, positioning there. So I think that, further upside, yes, I think it's achievable, but I think it's going to be a very rocky road over the next couple of months.
Peter, share with us, if you could, what is happening in commodities. I'm not going to get into commodity prices, but I just want to take you back, if I may, to 2008 or 2006, when billions of dollars were being put up to make new natural gas facilities in Papua New Guinea, maybe Australia, maybe Malaysia. Same with iron ore mines and coal mines that were in the middle of nowhere and required railroads of 500, 600 kilometers. And a lot of this could have been sustained if coal prices and natural gas prices and all would have been maybe 100% higher than what they are today. What happens if many of these the commodity prices don't rise and many of these companies head for bankruptcy? Could we then be staring at a longer-term commodity fall than this minor move of prices that may be happening on the Shanghai exchange?
Well, yes, exactly right. And then put your mind across as far as shipping. I was in Cyprus, and as you know, it's a gateway for global shipping. And we were discussing that with some ship people last week as far as ship brokers. And the oversupply of shipping in 11 and 12 was just, huge numbers as far as construction and then being put to sea. And now you've got many ships idle, and that's great concern as far as, the costs incurred as far as super tankers and Panamax and so on. Then you put your mind across to what's going on as far as Saudi and Russia. Their balance sheets are hemorrhaging, and that's just the big boys. You've got the miners, the Vales, the BHPs, Rios, and so on. The oil exploration that we saw in mining over that period as far as build up to 6, 7, 8, 9, 10 was, immense capital expenditure. one saving grace, I would say, is that the actual resources are still in the ground and they can be retrieved in the long run if you do see price recovery. And the thing that is of interest is to probably put your mind across to how the adaptiveness of the rig count and the Baker Hughes rig count and how oil prices go up and then all of a sudden the guys leave working at Walmart and return back to the rigs in the Gulf of Mexico or on land, quite simply because the price flexibility, the elasticity of the market. It's a little bit harder for mining companies to, mothball a project and then come back. But yes, you're probably going to see bankruptcies continue over the years ahead.
And in that scenario, Peter, what are investors then looking at? Because, even whether it's Brazil or shale gas, many of these guys are profitable if crude oil prices were over $70. Many of them will not even make it. And I can go across Brazilian, deep sea drilling, or you can look at Mozambique. If there is no
Nigeria.
Economics to the commodities market, Peter, why are we seeing stock prices rise?
Well, that's, why? And I think it comes down to one simple reasoning. Company restructures. We saw massive headcount cuts, and those in turn have been savings to balance sheets and what's happening as far as those re-engineering workforces. And companies are slashing headcount globally, and that just seems to be that we've noticed BHP. We've noticed BP. That happened in recent months, and to the satisfaction naturally of shareholders. So dividends are happy, boards are happy, and the simple reasoning is they can't hit those historical numbers other than cutting costs. And the easiest way to cut the costs is, well, we can't sell the bulldozer and we can't sell the ship. Let's trim the workforce, and that's been very evident. And banks are doing the same globally, and many industries are.
So, Peter, would you say that as far as the NASDAQ and the S&P is concerned, we could see a continuation of the rally, and maybe with that we see the rest of the Asian markets, India, China, probably continue to appreciate?
Yes, swept up in the mass. Look, I'm still... I think the jury's out as far as what Yellen's position is come September. There is a great degree of uncertainty as each day rolls closer to November, December. From it gets back to that Trump versus Clinton race to the White House, and I think all of these ingredients are going to add significant weight to, one, the US dollar, secondly, the markets, and thirdly, volatility. And whilst we can speculate, the end of July, what's going to happen, we've got possibilities as far as, further stimulus coming out at 3 o'clock or 4 o'clock today out of Tokyo. What impact that's going to have to yen, where China positions itself over the next month, and of course, looking at the US numbers. So I think that it's very hard to speculate. It seems to be on an upward trend at the moment, but the wool can be pulled very quickly over someone's eyes if you get continuing bad news. And the way that the crude market, if that's any barometer, I think you're going to be in the 30 handle over the first couple of weeks of August.
Peter, one last question. Should we be watching out for a sudden precipitating event? Because we know when markets go up a lot, they don't fall gradually. It's almost like adding one more tip of sand or one more flake of snow, and then you start to see the slide. Is it possible that now we are susceptible to an immediate, sudden, panic or a crash, which doesn't, which may just not happen, and then you just need that one last flake to make it happen?
Well, I'm curious to see what Yellen's positioning is. I think that there's a lot of, whilst we've got certain economies and certain markets performing quite well, we've got many that are spluttering along. Unemployment, it's weak. If you look at, holistically, the European situation, they could be already on precipices as far as future voting, leaving the Eurozone. Is it the right position where we need to be for a country to be belonging to Euro? All of these components can greatly impact markets moving forward, and I tend to agree that we may be on a precipice of what's going on in the foreseeable future. Could any major event could certainly impact. And that's why the Yellen situation, are we going to see a rate rise? What's going on with BOJ? All of these little things turn into big things when you will look back in hindsight.
All right, Peter, always a pleasure to speak to you. You have a great weekend ahead. Peter Mcguire, CEO.
Thank you very much, Ashu.